Hi, this is Michael Gillis with the Gillies Team at RE/MAX Legacy. Many of you are, I'm sure, aware that a new tax law has been passed. There's a lot of uncertainty about how that may affect real estate and specifically here locally. So today I'm going to talk about 4 of those changes and how they may affect us here in the local market. The first of these changes is that the amount that a taxpayer or family can deduct for what they pay in state and local property taxes has been reduced. It's actually been capped at $10,000. And in some high-cost, high-tax areas, this is going to have a real effect on what someone's income looks like after taxes at the end of the year. I took a quick look, and using the median income in Stafford and the median home price, that total tax number should be well below that $10,000 cap for a big portion of our market. Now, if someone is earning on the higher end or their property taxes are higher, whether it's because of size of the home or location or acreage or something like that, that can definitely have an effect. And so you'll want to check your individual situation to see how you're affected. But from a market standpoint, this shouldn't have the type of big sweeping changes that it might in other areas that, again, are more high tax or higher cost in general. The second item, the amount that can be deducted for what you pay in mortgage interest is changing as well. Under the previous code, mortgage interest could be deducted up to the first $1 million. That's changing and it's being reduced to $750,000. And so similar to item number 1, this is going to affect the upper end of prices in our area, and certainly will have an effect if someone is looking to purchase and they're looking at their overall picture. You know, how much am I going to be able to deduct? What sort of benefit from a tax perspective might this property bring me? This could have an effect there. Now, again, similar to item number 1, it's going to affect the upper end, the top couple of percent in our area, more so than the market as a whole. And so the important thing to keep in mind is if you've got a mortgage and it's up to $1 million, you can still refinance that. You'll be grandfathered in to the previous rules. New mortgages taken out after mid-December will be subject to that $750,000 cap. So keep that in mind, but also keep in mind that if you've got a mortgage under $750,000 or if you're looking at purchasing a home under $750,000, then you won't be affected by this change. The third item on my list is a big, we'll call it a no change. In earlier versions of the bill, when they were looking at how capital gains as it relates to real estate might be affected, they looked at changing the amount of time that someone would have to live in their home as a primary residence from 2 of the previous 5 years to 5 of the previous 8 years. And this is a huge change because one of the biggest benefits to home ownership in any area is that if you live in a home as your primary residence for 2 of the previous 5 years when you go to sell, your gains on the sale of that home, let's say that your gain is $100,000. Your gains are not taxable as capital gains. One of the biggest benefits for home ownership. The earlier versions of the bill, Congress had looked at changing that to 5 of the previous 8 years. The important thing to note there is our area is very transient. We've got a huge military contingent. We've got a ton of federal workers that are in and out, and a lot of contractors that end up moving areas. And so being here for a full 5 years and having to pay taxes if you sold before that 5-year mark would have a massive effect on our local market. There would be a lot of homes that wouldn't enter the market because they hadn't hit that 5-year mark, or it would make it a lot more expensive for local sellers to sell their home. This is a huge no change. This is something that was lobbied for by the real estate industry, and to have this stay at 2 of the previous 5 years for capital gains is a big, big victory for the real estate market. The last item, this is something that can affect sellers anywhere. So deductions for moving expenses are no longer allowed, with the caveat that if the seller is a member of the military, those deductions can still be factored in. And so if someone was looking at moving, they were going to have $15,000 in moving expenses previously, that could have been deducted from the tax return for the year in which they sold the home. That's no longer. That's something that did change, and it will affect the majority of sellers. And so keep that in mind as you're factoring in your moving costs and as you're working through that. The big thing to keep in mind when we look at these 4 changes is that you're going to hear quite a bit of negative reporting. Even the National Association of Realtors has said that some of these changes could have an effect of up to 10% on prices. Now, the key thing here is that our average sales price is below the threshold for those first 2 points, and I think that's gonna not hit us quite as hard as some areas with either higher taxes or higher average sales prices. So going into 2018, things still look really positive. If you watched my video from a couple weeks ago about how the end of 2017 may affect 2018, you'll remember that we talked about the market really looking positive. There's a lot of things that are really going for us, and in our area in particular, I don't anticipate these changes having a big negative effect. Now, I'm not a CPA. I can't give you tax advice. I can give you my opinion as it relates to real estate and how this may affect it. But if you do have specific questions, I can hook you up with a CPA to help you answer those. So 2018 so far is looking very, very good. We're excited about what's happening. If you have any questions, feel free to reach out, give us a call, or shoot us an email.